Welcome to Topic 8, Consolidations Part 2. In Topic 7, we learn about acquisition analysis. We learn about how to prepare consolidation adjustment entries at the date of acquisition, which was when I acquired business and we became a family. In this topic, I'll show you how to prepare consolidation adjustment entries, pre-acquisition entry at subsequent periods by assuming that it's now at least a year since I acquired your business. After we become a family, we still have our own sets of books and we need to prepare a separate book for our family, and this is called Consolidation Worksheet. The Consolidation Worksheet entries do not affect the underlying financial statements or the accounts of the parent or subsidiary. In this topic, we're considering consolidation in subsequent periods. As the consolidation is done every year based on the individual financial statements, or the accounts of the parent or the subsidiary, the entries in the consolidations from previous years do not carry over and they need to be repeated, sometimes exactly the same as in the previous years, sometimes with some adjustment. I'll show you how adjustments are made in years subsequent to acquisitions. In Topic 7, we learn about how to prepare acquisition analysis and pre-acquisition entry. In this topic, we'll learn about the use of a consolidation worksheet to record consolidation adjustment entries. I'll now work through exercise 27.14. This question requires us to prepare the consolidation worksheet at 30th of June 2023, which is 2 years after acquisition. I'll show you how adjustments are made in the form of journal entries. First, let's look at the acquisition analysis. There is a share of 25,000, return earnings of 16,000. You have previously recorded a goodwill of 2,500, therefore this needs to be deducted. The carrying amount of plant was lesser than the fair value. This needs to be revalued up by 3,000 to the fair value. Therefore, the difference is now added to the net fair value of identifiable asset and liability. The same applies to inventory. An outward revaluation of 2,500. We need to pay attention to revaluation. If it's an upward revaluation, this needs to be added to the net fair value of identifiable assets and liability. If it's a downward revaluation, it needs to be deducted. As you previously unrecorded asset relating to internally generated trademarks, these had a fair value of 4,000. This needs to be added. Now we have the net consideration transfer 40,000. Remember, there is also a previously held equity of 10,000. By comparing the net consideration transfer to the net fair value of identifiable assets and liability, the goodwill acquired is 4,850. Remember that you previously recorded the goodwill in a book of 2,500, so the unrecorded goodwill is 2,350. Now, we'll need to prepare the BCVR entries for 2023. However, I'll show you the BCVR we need 1 year after acquisition, which is 2022. Let's begin with plant. Since it has been 1 year after acquisition, depreciation of the plant during the year needs to be adjusted. As you can see, the first set of entry is exactly the same as the ones we would have prepared at date of acquisition. This is because consolidation entries do not carry over, so it needs to be repeated. Then we account for the depreciation expense for the year, which is by using the upward revaluation of 3,000 divided by the useful life of 6 years. We must not forget about the tax entry for depreciation. Then we look at 2023. Since it has been 2 years after acquisition, therefore, when we prepare the entries, again, the first set of entries will be the same. However, The opening return earnings needs to be adjusted as previous year depreciation expense will have reduced the profit, hence the closing return earnings. Then the tax entry for depreciation with an adjustment to opening return earning as well. Remember that the date for opening return earnings must be included. Next, we'll look at the BCVR entry for 2022, which is 1 year after acquisition. During 2022, 90% of inventory was sold. Therefore, we need an entry and adjustment to account for the sale of inventory. To do so, we debit cost of sale, credit the income tax expense, and we must credit transfer from BCVR. Then we need to account for 10% of inventory still on hand at 2022. Two years later, which is 2023, the remaining of 10% of inventory was sold. Therefore, we need to account for it. Debit the cost of sale, credit income tax, and credit the transfer from BCVR. This is to account for the 10% of inventory that we previously still had on hand, but we sold it in 2023. We do not need to consider adjustment for the sale of inventory in the previous period because those inventory were not in the business at the beginning of the current period. Now, let's look at other accounts that need to be adjusted. First, we consider trademark. Remember that previously you did not record the trademark, which had the fair value of $4,000. At acquisition, this was recorded. This entry here shows the BCVR of trademark at acquisition date. A year after acquisition, which was 2022, the trademark has now been amortized by $500, as trademark has a useful life of 8 years. So 4,000 divided by 8 years to give us the 500 amortization per year. We must also consider the tax effect for 500, which is 30%. 2 years later, which was in 2023, the amortization expense that we recorded in 2022 would have had an impact on the 2022 return earnings. Therefore, this means that the opening return earnings in 2023 will need to be adjusted. This is very much similar to the adjusted entries for depreciation that we prepared earlier. The BCVR entry for goodwill is repeated as prepared at acquisition date. After a lengthy process, we are now ready for the pre-acquisition entries. In 2022, the first year after acquisition, the pre-acquisition entry is similar to the one prepared at acquisition date, except the BCVR is debited by $9,000. This is to account for the sale of 90% of inventories during the year. We must then debit transfer to BCVR and credit the BCVR. This is to reflect the sale of 90% of inventory. Two years after acquisition, which is 2023, The pre-acquisition entry is similar to the one for 2022. However, retained earnings is debited by $16,575, which is to reflect the 90% sale of inventory from 2022 and the previous period transfer from pre-acquisition retained earnings to general reserve. The BCVR reflects the 10% of inventory sale. Then we must show the current transfer of BCVR due to the sale of inventory. The previous period transfer from pre-acquisition retained earnings and general reserve is also shown here. I have shown you how adjusting entries are made in the form of journal entries. When a consolidation worksheet is used, what we need to do is to record the adjustment on the worksheet. All the accounts are presented in the worksheet. All we need to do is to insert the adjustment onto the worksheet. For example, the current period transfer of $175 from BCVR due to the sale of 10% of inventory should be recorded in the debit column of the consolidated worksheet, and the 175 is then credited to the credit column, inserted to the credit column under BCVR in the worksheet. I hope you enjoy part 2 of consolidation as much as I do.